The financial world experienced dramatic volatility this week following the implementation and subsequent modification of sweeping trade policies. What began as a market meltdown transformed into a remarkable recovery when the administration announced a partial retreat from its original tariff strategy. The three key developments: the administration's decision to adjust its trade approach was designed primarily to stabilize the increasingly nervous markets. The revised plan maintains a 10% tariff rate, still considered significant by economic experts, but represents a substantial reduction from the initial announcement. Wall Street responded with enthusiasm to this policy adjustment. Investors seemed eager to embrace the positive aspects of the announcement while setting aside lingering uncertainties. The result was an astonishing market surge that left even seasoned financial commentators struggling to process the scale of the rebound. Fundamentally, this represents a strategic reversal for the administration. Despite previous insistence that no concessions would be made, mounting pressure from plummeting markets forced a policy pivot, though officials attempted to frame this as part of a calculated long-term strategy. Behind the market moves, the administration's Treasury Secretary emerged to reassure global markets that a ceiling had been established, suggesting that the tumultuous trade standoff would not deteriorate further, at least for countries other than China. This announcement appeared to be directly aimed at calming investor fears. The market response was immediate and dramatic. As one financial analyst observed, this was obviously a relief rally for markets. Trading was so volatile that market trackers reported difficulty keeping pace with the rapidly changing numbers, with one commentator exclaiming in disbelief, "Are the numbers I'm seeing correct? We're up 900 points? Is this real?" This positive movement comes after a period of severe instability largely attributed to administration-induced uncertainty. Despite the revised approach, American consumers will still face what many economists have termed an import tax, potentially amounting to thousands of dollars annually per household depending on purchasing habits. Economic impact and expert analysis. Most economic experts view these events as a self-inflicted economic disruption with questionable benefits. The administration's strategy appears to be claiming victory after partially solving a crisis of its own making. Some observers are attempting to provide the administration with face-saving options to abandon the remaining tariffs, suggesting this partial retreat was part of a brilliant negotiation strategy. However, the facts indicate that even the reduced 10% tariff rate continues to pose significant risks to global trade. Just days earlier, reputable news organizations like Reuters and The Guardian described the 10% tariff, which remains in place, as smashing global trade norms and representing a seismic shift to global trade. The administration appears to have employed an anchoring effect by initially threatening higher tariffs. The 10% rate now feels like relief, though it would have seemed alarming if presented as the initial proposal. Long-term consequential experts express continued concern despite the market rebound. One analyst noted, "This is a long way from fully backing off. This still leaves the United States as the most tariff-heavy industrialized country in the world, and it's not even close." Another economic commentator emphasized the lasting damage to trade relationships. "He has permanently injected uncertainty into markets. You can't really put the tariff threat toothpaste back in the tube." The credibility of American trade policy has sustained significant damage. As one observer pointed out, it still raises the question of why other countries would deepen their ties with us after we punch them in the face. While the administration claims that numerous countries have reached out to negotiate deals, this appears to be a natural defensive reaction to a threatening economic situation rather than a demonstration of successful diplomacy. The financial community's consensus remains that this partial retreat represents an acknowledgement of a failed policy approach. Despite internal resistance to concessions, mounting pressure from catastrophic market reactions forced a reversal, though significant tariffs remain in place. The path forward: the administration now faces a delicate balancing act. Having stepped back from the brink of a potentially devastating trade war, it must now find a way to maintain credibility while minimizing further economic damage. For investors and consumers alike, uncertainty remains the dominant theme. The modified tariff structure continues to pose significant challenges to global trade, and the demonstrated willingness to use tariffs as a negotiating tool has fundamentally altered how international partners view American economic policy. As markets attempt to find stability in this new reality, the ultimate impact on American businesses, workers, and consumers remains to be seen. What is clear is that the administration's approach to trade policy has introduced a new era of volatility into global markets, one that may have lasting consequences beyond any short-term political calculations. The coming weeks will be crucial in determining whether this partial retreat represents the beginning of a more measured approach to international trade or merely a temporary pause in an increasingly unpredictable economic strategy.